they buy big on dips. I'm going to bring in now Steve Sosnick, Interactive Brokers Chief Strategist. And Steve, listen, I know it's great for your business, but you also are concerned about retail investors who may not understand some of the warning signs that they should be looking at with respect to going all in on every dip.
Well, thank you, Charles, for bringing it up that way, because my feeling is, you can't fight a trend. You can't fight the tape. That's an old expression that holds a lot of water. But what you always should be doing is thinking about, like, when might the trend be changing? How am I going to be sensitive to it? And so buying the dip has worked essentially almost in a foolproof manner for the better part of, call it 10 plus years, probably since the global financial crisis.
I think you go back to March of 2009. We've had some, but essentially if you bought the dips since then, you've done extraordinarily well.
You've tended to do very well, but the problem is that can lead to complacency. Not every dip is a buying opportunity every single time. And I think you could do it, but you better be aware of times where the situation might be changing, because it's very easy to go from constructive dip buying to being a bag holder.
Is there one key thing? I know there's several things probably in your dashboard that you're paying attention to, but there's one thing you can impart to our viewers. Increased volatility, any sort of signal that will say, okay, let me just pay closer attention.
There's another thing that's historically typically true, is that volatility tends to increase at turning points. And so when you start to see a trend peter out and volatility increase, that's not necessarily a red flag, but it's often a yellow flag, particularly when it's accompanied by some breakdowns in the underlying trends, especially when you have a momentum-driven market where people are investing on those trends.
Right. Good stuff there. I want to talk about the chips. I know the buying right now, retail, they love their chips. Micron, number 1, NVIDIA, number 3, and DRAM, the ETF, number 6.
And we could go down among our top 25. I think it's like 12 of the top 25 are chip related, including some double levered single stock ETFs on Micron and SanDisk. They love the chips. And again, this is where it becomes, I'm not saying it's wrong. It certainly worked really well. They have shown a little bit of the parabolic trend is broken. Parabolic trends, although we moved a little sideways, but when parabolic trends end, they end unpredictably and often in a very nasty manner. So again, this is why I'm not going to say sell all your tech stocks right now. That would be insanity. But it would also behoove people to start to notice, maybe you take a profit here and there. Maybe you want to de-risk a little. Maybe you want to realize that, if you had a neutral investment portfolio before, you're going to be very heavily weighted in tech now because it's so outperformed.
Well, I personally have always been sort of concerned. I've never recommended any 3 times. I don't think even maybe double, but it's rare. But, when you start to see 3 times an ETF, 3 times an individual stock, and you have to be so extraordinarily nimble. It reminds me like of people who don't understand options. You can make money 5 times in a row and lose it all on the 6th go-round.
Well, the problem here is they're embedded options, and that's where the real problem comes in. People don't read prospectuses, but on the front page of prospectus in big bold letters, these all have a similarity. They all say that these match the daily returns of the underlying product. They don't match the ongoing returns, and you tend to underperform. And the higher the volatility, because you're buying options that decay faster, you underperform even more. So these are trading vehicles, not investment vehicles.
Speaking of risk, I want to segue into prediction markets because they are just exploding.
Yes.
I saw a stat today on the betting on Kelce and Poly markets on the World Cup. Your firm doesn't do sports, but you do have a predictions market.
We do. IBK, our forecast trader. We've limited ourselves. We've avoided the entertainment space, as I'm going to call it. We basically keep everything to something that is either markets or economic related. So that's politics, that's interest rates, there's a whole climate, weather. Yes, thank you. I was reaching for that one. Weather. So all these things, I can draw a line between that and a hedgeable portfolio risk. And that's been our focus so far. It's less sexy, but I think it's more sustainable.
We're going to head into earnings season soon. What's your thinking there? Because you wrote something about the old cliche when the analysts would come on the call and they say, "Great quarter, guys." I mean, last time it really was great quarter, guys. Yes. But they always say great quarter, guys.
They always say, and the tongue in cheek with the great quarter, guys, was also in relation just to the market's performance, because it really was great quarter, guys.
Right.
But I think as we get into earnings season, which starts up in earnest next week, really, we have to start thinking about, are the expectations too high? Or more importantly, have we priced in too many good expectations? Think about it, let's say, as a high jumper. You know, you could have the best high jumper in the world. If you set the bar too high, he's not going to clear it. And I think this market has been quite a high jumper or a pole vault or whatever analogy you want to use. But when we saw stocks like NVIDIA and Micron do really not much after terrific earnings, you have to wonder in some cases, number one, has the bar either been set too high, or number two, is there fresh money waiting to invest in some of these winners, even when the earnings are expected to be good, they deliver them, but is there fresh money waiting on that?
Is there some psychology too? People say, okay, it was absolutely phenomenal, but you can never do it again. Like it feels like, okay, it always feels like, okay, it was so great, it's unrepeatable. So your 86% profit margins are eventually going to go to 80 and 78. I mean, because to your point, some of these stocks have not reacted the way you would think they would have been. It's been counterintuitive.
Yeah, and so, again, I think it's in some ways like, find me the person who's not already invested in NVIDIA or Micron. You know, that's part of it. I think the other part of it is just, in some cases, I think we've taken the guidance. The companies are giving us a quarter or two of great guidance, which let me stipulate, these are great reasons for stocks to rally. Earnings guidance, there is no better reason. But I think the market in some ways is extrapolating a quarter or two of good guidance to 3 to 5 years of guidance, and you get into some trouble if you do that.
All right. Good stuff, Steve.
Thanks, Charles.
Thank you, buddy. Appreciate it. All right, folks.